Okay, so let's take an equivalent scenario. Once again, if we are entering in on a position here, we set up our risk amount. We're calculating this value minus this value to get our stop loss value. We have our profit target value from our entry up to a high. When you're trading futures, when you buy a contract, you're basically paying to maintain control of a contract that can either gain value or lose value. Okay, and if each one of these values is a point, each contract is going to be worth $5 either gain or loss per point traveled. So if we're calculating the risk by subtracting these two, we get 5.75 points, which times the $5 amount is going to put us approximately at $28.75 worth of risk per contract that we hold. And what we're trying to do on the profit side is 5.78 times our risk, which would equal that 166.25. Now with future contracts, you can't buy fractional contracts. You have to either round down or round up. But say in this example, if you were able to hold about 4 contracts, now if you operate those contracts based off of where you're trading, usually it's about $50 of what's called margin that you need to keep per contract that you're operating. Say you had about $400 worth of capital in your account and you wanted to operate 4 contracts. That would mean you need to maintain a $200 margin buffer. And if you have a $100 stop loss, approximately, that means that if your total position of 4 of these contracts dropped down to your stop loss, your account buffer would only go to $300, in which case you're above that $200 worth of margin to be able to operate those contracts, in which case you can see now the capital requirement is substantially lower.